Okay, you're considering owning a car dealership. From the road, it can look like a large parking lot where expensive products move quickly. Salespeople earn commissions, and the owner collects a percentage from every set of keys. The contradiction is that a dealership can process tens of millions of dollars in annual sales while keeping only a narrow portion after vehicle cost, payroll, property expense, interest, advertising, compliance, and taxes. This breakdown will show what you are actually buying, where the capital goes, how each department earns money, and why inventory speed matters more than the price tags facing the highway. The first decision is not which brand you like. It is which operating model you can finance and manage. A franchised new vehicle store sells under an automaker's name and normally combines new vehicles, used vehicles, financing products, parts, maintenance, warranty work, and sometimes collision repair. An independent used car dealer has more freedom over branding, inventory, pricing, and facilities. But it does not automatically receive factory warranty work, manufacturer advertising support, or access to new vehicles. A small, independent lot and a metropolitan luxury franchise may both be called dealerships. Yet economically, they resemble different industries. The scale of American franchised retailing explains why the business attracts attention. Not a reported 16,990 franchised light vehicle dealers in 2025 together. They sold about 16.2 million new light-duty vehicles, produced more than $1.3 trillion in total sales, and wrote over 276 million repair orders. The average sales figure was approximately $76.6 million per franchised dealership. But that is revenue, not owner income, and averages conceal enormous differences among rural single-point stores. Urban dealer groups, import franchises, domestic brands, and premium locations. The business, therefore, creates a visual illusion. Customers see the retail price of each vehicle and mentally multiply it by the number of transactions. The owner sees a different picture. Borrowed inventory, narrow vehicle, gross margins, payroll due every week, manufacturer obligations, and departments with completely different profit characteristics. A dealership can sell more cars and become less liquid if those sales require heavy discounting, expensive advertising, rising floor plan interest, or delayed lender funding. Volume is useful only when the contribution survives the full cost. Structure, that revenue versus profit distinction, is the organizing idea for this channel. We examine ownership by separating the impressive number customers see from the smaller number that remains after the business pays everyone else. With a dealership, the showroom receives most of the attention, but the balance sheet is controlled by inventory financing, turnover, gross profit by department, fixed overhead, and the timing of cash. A store can look busy and still experience a cash squeeze. Another can sell fewer vehicles, yet produce stronger profit because its service bays, finance, office, and inventory controls are better. Buying an existing franchise is not the same as buying its building. A transaction may include land, improvements, equipment, parts inventory, used vehicles, working capital, and the operating assets of the dealership. It may also include blue sky value, the price assigned to the franchise rights, customer base, reputation, expected earnings, and strategic territory beyond the identifiable assets. The manufacturer normally must approve a buyer, and the buyer may need to demonstrate relevant experience, acceptable capitalization, and a compliant operating plan. Therefore, having enough money to negotiate with the seller does not guarantee permission to operate the franchise. Public dealer filings confirm that. Franchise agreements commonly give manufacturers approval rights over dealership ownership and management changes. Starting a store from the ground up creates a different stack of costs. The owner may need a site with suitable zoning and road access, environmental review, architectural and engineering work, utility connections, paving, drainage, lighting, signage, security, showroom construction, service bays, lifts, alignment equipment, diagnostic tools, parts storage, computers, communications, systems, insurance, licenses, legal work, hiring, training, launch advertising, and months of working capital. A manufacturer can also require specific exterior materials, furniture, technology, signage, charging capability, or later renovations. These obligations vary by brand and market. So a universal franchise startup price would be misleading. The practical conclusion is simpler. A full franchised operation is not a modest retail startup. Property, facilities, equipment, inventory support, and working capital must all be funded. An independent used dealership reduces some of those barriers. It can begin on leased property with a smaller office, limited reconditioning capacity, and fewer employees. But lower entry cost shifts pressure elsewhere. The owner must source vehicles without factory allocation, build lender relationships, arrange inventory credit, establish consumer trust, manage title work, absorb reconditioning surprises, and create demand without a major manufacturer's brand. If the operation offers in-house financing, it also becomes a credit business that must collect payments, estimate defaults, repossess legally, and maintain enough cash to survive slow repayment. Independence removes manufacturer control, not operational complexity. Inventory is the dealership's largest visible asset and one of its largest hidden liabilities. Most franchise dealers do not pay cash for every new vehicle. They use floor plan financing, a revolving form of inventory credit secured by the vehicles. The lender advances funds when inventory arrives. Interest accumulates while the vehicle remains unsold, and the related balance is paid when that unit is sold. Public dealership filings show that these rates are commonly variable and that changes in interest rates and average. Inventory levels can materially alter floor plan expense. Manufacturers may provide assistance intended to offset some carrying cost, but the assistance does not eliminate the need for disciplined turnover. This means a row of unsold vehicles is not frozen wealth. It is financed merchandise consuming interest, insurance, space, cleaning, security, administrative attention, and eventually pricing flexibility. A vehicle that stays too long may require a discount, an incentive transfer to another store, wholesale disposal, or an owner-funded principal reduction under the credit agreement. The relevant metric is not simply how many cars are on the lot. It is how many days of supply the store is carrying, how quickly each category turns, and whether the gross profit expected from a sale is large enough to cover the accumulated carrying cost. New vehicle allocation also changes the owner's control. A franchise cannot always order any quantity of any configuration it prefers. Manufacturers plan production and distribute vehicles through allocation systems influenced by market demand, prior sales, inventory, performance, geography, and brand policies. A fast-selling store can gain an advantage because desirable inventory produces more sales history, which may support future allocation. A slow store can become trapped with unpopular colors, packages, or power. The owner, therefore, manages two negotiations at once, one with customers over price and another, less visible one, with the manufacturer over inventory, standards, and performance. Public dealership filings identify vehicle supply and manufacturer policies as material operating dependencies. Used inventory is acquired through trade-ins, direct purchases, lease returns, interstore transfers, and wholesale auctions. The purchase price is only the first number. Transportation, auction fees, title work, inspection, tires, brakes, glass, paint, detailing, mechanical repairs, and the time spent in reconditioning all affect the true cost. A vehicle bought cheaply can become expensive before reaching the retail line. A skilled used car department does not merely buy low and sell high. It appraises risk quickly, sets a realistic reconditioning budget, prices against a changing market, and exits mistakes before they become aged inventory. Now the economic picture starts to reverse. Vehicle sales generate most dealership revenue, but they do not necessarily generate most dealership gross profit. AutoNation's 2025 filing provides a useful large company illustration, not a promise for a typical local store. New vehicles represented about 49% of its revenue, but only 13.5% of gross profit. Used vehicles represented about 28% of revenue and 9.4% of gross profit. Parts and service generated 17.5% of revenue, but 47.6% of gross profit, while finance and insurance generated 5.3% of revenue and 29.5% of gross profit. The percentages will differ at another dealership, but the underlying lesson is central. The smallest revenue lines can carry the strongest economics. Front-end vehicle gross profit is the difference between vehicle revenue and the direct recorded cost of the vehicle. Adjusted for applicable incentives and accounting items, it is not net profit. From that gross profit, the business still must support commissions, management, rent or mortgage expense, utilities, advertising, software, insurance, training, interest, depreciation, professional fees, compliance, and taxes. Internet price comparison has made the vehicle itself easier to shop across competing stores. That transparency pressures the front end and increases the importance of departments that are harder to compare with one search. Manufacturer payments can complicate that calculation. Programs may include incentives, floor plan assistance, performance payments, advertising support, or holdback-like amounts tied to vehicles and program rules. These items vary by brand and period, and some are earned only after conditions are met. Documentation and other permitted fees also vary by state and must be disclosed and handled lawfully. For buyers, the monthly payment can hide the total economics because a longer loan term may reduce the payment while increasing total interest. For owners, the lesson is to measure complete deal profitability without allowing one favorable line to conceal a weak trade value. Excessive discount, costly incentive, or compliance problem. Public dealership filings separately identify manufacturer holdbacks, incentives, cooperative advertising credits, and floor plan assistance. The Finance and Insurance Office earns money by arranging loans or leases and selling OPTION/AL protection products. When a customer uses deal-arranged financing, lenders quote a wholesale rate, commonly called the buy rate. The contract rate offered to the customer can be higher, subject to lender programs and applicable law, and the dealer may receive compensation connected to that difference. Dealers can also earn commissions from vehicle service contracts, maintenance plans, guaranteed asset protection, Tyrand wheel coverage, and other products. These products are not automatically abusive, but they must be accurately described, voluntarily accepted, priced transparently, and administered according to the contract. The finance office is profitable because it combines distribution with timing. The customer has already chosen a vehicle, negotiated a trade, and invested time in the transaction. A trained finance manager can present several products during the final stage and measure product penetration, revenue per vehicle retailed, cancellation rates, and lender performance. However, strong short-term production can create long-term problems if employees hide products, misstate requirements, discriminate in pricing, or focus only on monthly payment. The FTC and CFPB repeatedly advise consumers to compare total cost, review optional add-ons, and shop financing because deal-arranged rates can include compensation above the lenders by rates. Some dealer groups also participate in future underwriting results through reinsurance or retrospective commission arrangements. Connected to protection products, that can add a second layer of income after the initial sale, but it is not effortless or automatically tax-free. A valid insurance structure requires genuine risk transfer, risk distribution, regulatory compliance, actuarial support, administration, reserves, and careful tax treatment. The IRS has increased scrutiny of certain micro-captive arrangements and emphasizes that an entity must actually operate as an insurance company to qualify for specialized treatment. For an owner, this is a professional legal, insurance, and tax project, not a casual offshore shortcut. Parts and service provide the recurring relationship that vehicle sales begin. NADA reported approximately $164.6 billion of service and parts sales at franchised new vehicle dealerships in 2025, averaging about $9.7 million per dealership and more than 16,000 repair orders per store. Again, sales are not profit, but fixed operations can produce attractive gross margins because customers are paying for skilled labor, diagnostic capability, parts availability, convenience, warranty, authorization, and accountability. The department also reconditions used inventory and prepares new vehicles, so its capacity affects both retail service revenue and the speed at which vehicles become saleable. Service demand is steadier than vehicle demand, but it is not automatic. The dealership needs technicians, advisors, parts specialists, dispatching lifts, tools, training, technical information, warranty administration, appointment capacity, and quality control. A store can own a beautiful service building and still lose customers through long waits, poor communication, repeat repairs, or technician shortages. Warranty work supplies volume and customer contact. Although reimbursement rules and labor times differ from customer pay work, collision repair can add revenue, but it introduces insurer relationships, estimating systems, parts delays, paint facilities, environmental controls, and longer cycle times. Owners monitor service absorption, which asks how much of the dealership's fixed overhead is covered by gross profit from parts, service, and sometimes body operations under the store's chosen formula. A higher absorption rate means the dealership is less dependent on vehicle gross profit to pay recurring overhead. Reaching 100% does not make every subsequent vehicle sale pure net profit, because selling a car still creates variable costs, commissions, interest effects, and taxes. It does mean the fixed operations engine is carrying a larger share of the building, administrative staff, and other recurring expense, which can make a downturn more survivable. Labor economics inside the shop are unusual. Many technicians are compensated under flat rate systems that assign a standard labor time to each operation. An efficient technician may complete more billed hours than physical hours worked, while a difficult diagnosis, unavailable part, or low workload can reduce earnings. The system can reward skill and speed, but it can also create quality, retention, and morale risks if poorly managed. The owner must balance technician productivity with comeback rates, customer satisfaction, safety, training, warranty, documentation, and fair dispatching. Losing experienced technicians can restrict service capacity even when customer demand is strong. The dealership also carries a large non-technical workforce. NADA estimated about 1.12 million employees across franchised light vehicle dealerships in 2025, averaging 65 employees per store. A specific dealership may employ sales consultants, desk managers, finance managers, service advisors, technicians, parts staff, detailers, warranty administrators, title clerks, accountants, human resources, personnel, marketers, information technology support, porters, and executives. Payroll is therefore not a small accessory to the inventory. It is a core operating system, and manager-operated ownership requires enough gross profit to pay leadership that an owner-operator might otherwise provide. Personally, sales compensation often combines commissions, bonuses, minimum payments, and performance targets. Dealerships may use an internal amount, sometimes called a PAC, when calculating commissionable gross profit, but plans vary by employer and state law. The owner must design compensation that moves inventory without encouraging deceptive behavior, destructive discounting, or employee turnover. Finance managers may be paid on product performance, service advisors on labor and parts sales, and technicians on flagged hours. Each incentive can improve one metric while damaging another. So governance matters as much as motivation. Technology is another fixed cost with operational leverage. Dealer management systems connect accounting, inventory, repair orders, parts, customer records, payroll interfaces, and transaction documents. Customer relationship systems manage leads and follow-up. Digital retailing, pricing tools, vehicle history services, cybersecurity, phones, websites, advertising platforms, lender portals, manufacturer systems, and compliance tools create a dense technology stack. Switching a core system can disrupt the entire store. A large outage can slow sales, service, payroll, and accounting simultaneously, which means software resilience, backups, vendor contracts, and incident planning belong in the ownership model. AutoNation reported that a 2024 dealer management system outage disrupted dealership operations and affected earnings. Regulation extends through nearly every department. Dealers must follow state licensing, title, advertising fee, insurance, and consumer credit rules. Federal obligations may involve credit reporting, adverse action notices, privacy, information security, used vehicle disclosures, warranties, telemarketing, employment, environmental practices, and anti-discrimination law. Most dealers arranging consumer financing or leases are covered by the FTC. Safeguards rule and must maintain a written information security program appropriate to their operations. The rule also includes breach notification obligations for qualifying incidents. Compliance, therefore, requires people, systems, documentation, training, testing, and outside expertise, rather than a binder that nobody opens. Consider Maya, who is evaluating a profitable-looking suburban franchise. offered with the operating business but not the underlying real estate. The store reports $72 million in annual revenue. That number sounds enormous, yet she does not begin by applying a simple percentage and calling the result income. She separates new vehicles, used vehicles, finance products, service, parts, and collision. She checks gross profit by department, normalizes unusual incentive income, examines technician vacancies, measures aged inventory, reviews floor plan rates, studies warranty receivables, and determines whether the seller owns related companies receiving rent or product income. Maya then rebuilds cash flow under her ownership. The seller works full-time and pays himself through several entities, so she adds the cost of a replacement general manager. The building lease resets after the sale, increasing occupancy expense. Several service lifts need replacement, and the manufacturer expects a facility update. The used inventory includes slow units that may require discounts. A strong reported profit can shrink after these adjustments, while a weak-looking store can improve if its service capacity is underused and inventory discipline is fixable. The purchase price only makes sense after the future operating model, debt service, working capital, and required capital expenditure are included. Tax accounting can affect timing but cannot rescue poor operations. Eligible dealerships may elect LIFO inventory accounting under federal rules. In periods of rising inventory costs, LIFO can defer taxable income by assigning newer, higher costs to units treated as sold, but the method has detailed eligibility, consistency, and recapture implications. It changes when income is recognized. It does not create customer demand or operating profit. Likewise, owning the real estate in a separate entity may separate property economics from dealership economics. Yet rent paid by the store remains a real expense, even when another company controlled by the owner receives it. Expansion can improve the model through shared accounting, centralized marketing, purchasing power, executive talent, data, and diversification across brands and markets. It can also magnify debt, integration risk, cultural problems, and manufacturer exposure. A group with several stores may relocate used inventory faster, negotiate some vendor contracts more effectively, and spread corporate overhead across more revenue. But scale does not remove the need to run each rooftop. One poorly controlled acquisition can consume management, attention, and working capital, while its reported revenue makes the organization look larger. So, what does a dealership owner actually earn? There is no responsible universal answer. Owner compensation can include salary for active work, distributions from dealership profit, rent from separately owned property, and income from related finance or insurance arrangements. It can also be reduced by acquisition debt, partner rights, reinvestment, taxes, capital projects, and cash retained for inventory. Public dealer groups demonstrate that the business can generate substantial profit at scale, but their purchasing power, management depth, brand mix, financing access, and geographic diversification do not describe a first-time single-store buyer. The best dealership is not necessarily the one with the largest showroom or highest sales total. It is the one that acquires inventory intelligently, turns it before financing erodes the margin, earns compliant finance income, retains productive technicians, converts buyers into service customers, controls overhead, and holds enough liquidity for slow periods and required investment. The vehicle sale opens the relationship. The economics are created across financing, protection products, maintenance, parts, trade-ins, repeat purchases, and disciplined use of capital over several years.